Just about every financial publication that you pick up today tells you how perfect ETFs, or exchange-traded funds, are for your investment portfolio. While there's a lot of truth to that statement, we advise all investors use some caution when investing in ETFs. But first, what is an ETF? An ETF, or an exchange-traded fund, is an investment product that represents a basket of securities used to mirror an index, such as the S&P 500, the Dow Jones Industrial, the Morgan Stanley World Index, or if you like a particular sector, say technology, pharmaceuticals, biotech, or perhaps your interest is in one particular country, such as China, India, Malaysia. There are ETFs available to track every investment opportunity in the world. Now, the benefits for ETFs are twofold. One, an ETF trades like a stock. That is, like a stock, you can buy it in the morning if you want and sell it in the afternoon. Or do the opposite, sell then buy. You can have a market order on that ETF. Say if it deteriorates 5% or 10%, you can sell it as a market order. The second benefit to ETFs is that it's comprised or structured very similar to a mutual fund in respect to diversification. Remember, the ETF is tracking a basket of stocks, not just one. So you get the best of both worlds when you buy an ETF, essentially. Diversification and flexibility to trade it like a stock. Now, a couple of things to keep in mind when investing in ETFs. There are so many of them out there now that you just don't know exactly what they are and what they actually invest in. Remember, they're sector or kind of shotgun rifle approach investments because they're just going to hone in on a particular industry or country. So the risk has sometimes has the issue there is that it goes up higher than a normal, generalized, well-diversified mutual fund, if you will. So keep in mind when buying ETFs that you buy an ETF that the liquidity is very good or very high, that it's not thinly traded. As a rule of thumb, you may want to buy an ETF that is trading at least 100,000 shares a day. So not only do you track the ETF, but also track the underlying index that it's trying to mirror. For example, if it's trying to mirror the S&P 500, take a look at the S&P 500. That'll give you an indication as to how convinced buyers or sellers are on a given day. So remember, the lesson learned from 2008, always assess your risk tolerance.